I was about to sell an investment I'd owned for 3 years. The share price had gone absolutely nowhere. At the last minute though, I checked one number that brokerage apps never show you. And it was like flicking on a light in a dark room. Suddenly I could see the truth. And it turns out this stock was one of my best performers. If I hadn't checked that number, I would have sold it for the wrong reason. And the scary part is, I was doing exactly what most investors do, making a big decision without all the facts. Here's why that happens. When most people check their portfolio, they look at one thing, the share price, or maybe a single percentage return next to the investment. And that number feels definitive. It feels like this is how I'm doing. But in reality, that number is only telling you part of the story. Here's why that number in your broker app can be so dangerous. Because it doesn't look like an estimate, it looks final. It's pretty clean, it's simple, it's usually red or green. Your brain treats it like a verdict. You don't question it, but you do react to it emotionally. If it's green, you relax. If it's red, you feel pressure to act. And the brutal truth is, this is not really investing. It's psychological conditioning. And the simpler the number, the more confident it makes you feel, even when it's missing critical information. The big problem with most brokerage apps is that they track performance in the simplest way possible. What you bought it for versus where it trades today. That's useful, but it's only a starting point. It's not the same thing as real investment performance, because investing returns are affected by way more than just the share price. Things like dividends, you've got fees, timing, sometimes currency. And if those aren't included, the number you're looking at is incomplete. Simple as that. And if you can't measure your investment performance accurately, you can't make fully informed decisions. But there's another big piece most broker apps don't track at all. What actually happened after you sold something. In other words, how your past decisions actually played out. Because once a position is closed, it usually disappears from view. The app moves on, but your decisions don't, because realized returns are the only place you can see how your past decisions actually affected your results. So imagine you've done 3 investments over the past couple of years, and each one you ended up selling out of for a massive loss. Then now you've bought a 4th investment, which for whatever reason happens to be up 20%. If you open your brokerage app right now, it's going to say you're up 20%, but it's not going to factor in all the past terrible decisions you made when you sold for a loss out of those 3 positions. And so without that information, you're only ever looking forward. You're never learning backward. And if you don't know what actually worked and what didn't, you're not really tracking performance at all. You're just guessing. Serious investors don't just check returns out of curiosity's sake. They check them to decide, should I hold this? Should I buy more? Should I sell? If the number is missing key pieces, the decision that follows is built on the wrong foundation. And that's how I almost sold one of my better investments. Let me give you a real example that happened to me. A few years ago, I owned a bank stock. It was a blue chip, solid business, nothing exciting. But for about 3 years, the share price went absolutely nowhere. There was no breakout, no trend, just sideways. And every time I opened my brokerage app, it looked like dead money. And after a while, that thought starts creeping in, why am I still holding this? I could have sold it, reallocated the money, moved on, and honestly, that would have felt like the sensible thing to do. But right before I sold, I stopped and checked something my broker never made obvious. I added up every dividend that stock had ever paid me over those 3 years. And when I did that, the picture completely changed. Because over that period, I'd already received back around 40% of my original investment. 40%. Not on paper, but in cash. And suddenly that flat investment wasn't flat at all. It was quietly doing exactly what I'd bought it for, making me money. And if I'd sold based on price alone, I would have sold one of my better performers. And not because the investment was bad, but because the number I was looking at was incomplete. And I know for a fact I'm not the only one who's nearly made that mistake. Most people wouldn't have checked. They would have sold, felt relieved, and moved on. And here's the part nobody notices. They wouldn't think, damn, I sold a good investment. They'd think, that thing was dead anyway. The mistake never registers. There's no alert, there's no obvious pain. You don't realize what you gave up until potentially years later when you compare outcomes and can't quite explain the gap. Or worse, you never realize at all. And that's why this is so dangerous. But this isn't just a dividend stock problem. It shows up in ETFs, portfolios built over long periods, international investments, and anything where money goes in and out. Anytime cash flows matter, price alone stops telling the truth. But most people don't realize that. They just see a number, and react to it. And one of the biggest blind spots is currency gain. Because with foreign investments, you're not just investing in the company, you're also exposed to the exchange rate, whether you think about it or not. Let me give you a real example. My co-founder Tom once bought a US stock. The share price went immediately down. So if you looked at his brokerage app, it was clearly in the red. And most people would have felt bad and started thinking, was this a bad investment? But when he actually looked at the full picture, something interesting showed up, because over that same period, the dollar had fallen against the US dollar. So when you factored in the currency move, even though the share price was down, his investment was actually up overall. Yet again, the number in the app was missing a crucial part of the story. And if he had trusted that headline number, he would have thought he was losing when he wasn't. And that's how easy it is to misread performance when you only look at share price. So here's the real cost of not measuring your investment performance correctly. It's not that people miss a dividend, it's that they misallocate future money. They add capital to things that look like they're working and pull money from things that actually are. And once that happens, it starts compounding, because one bad signal affects the next decision. You rebalance based on noise. You stop contributing to the right asset and you double down on the wrong one. And the worst part, you think you're being disciplined. You think you're being rational, but you're optimizing against the wrong number. It's like trying to lose weight when your scales are reading wrong by 5 kg. You'll never hit your target if your measurements aren't accurate. So this is what proper investment tracking actually gives you. It's not about prettier charts. It's not about more data. It's a feedback loop. It shows you what actually happened after you made a decision, not what you hoped would happen, not what looked good in the moment. It tells you which decisions paid off, which ones didn't, and where your returns actually came from. And that matters more than people realize, because without that feedback, every result feels ambiguous. If something works, you don't know whether it was skill, luck, timing, or just the market rising. And if something doesn't work, you don't know whether the idea was wrong, the execution was wrong, or you just didn't give it enough time. And proper tracking removes that ambiguity. And that's how you separate skill from luck and noise from signal. And without that separation, you're not really learning, you're just accumulating positions. Without proper tracking, you're just flying blind and calling it long-term investing. So this is why serious investors track everything. Not because they enjoy complexity and not because they want more spreadsheets, but because they understand the value of accuracy. They want to know what's actually happening with my money, not how does this look today? Not how does this feel right now? They understand something most people don't. Markets create noise and then your emotions end up amplifying it. And tracking is how you stay grounded. It's how you stop reacting to your emotions. Serious investors don't optimize for comfort, they optimize for clarity, because the clarity compounds. When you know what's actually working, you can do more of it. When you know what isn't, you can stop repeating it. And over years, not weeks, that difference becomes enormous. And just to be clear, whether you track properly or not, the ATO is looking at everything. They see income, they see currency impacts, they see realized gains. They don't see guesses, they don't see estimates, and they don't take kindly to excuses like, but my broker said so. They see numbers, and a small tracking failure today will cascade into big problems in the future. And when it shows up, it usually shows up at the worst possible time. So this isn't about making better decisions. It's also about not being surprised later by something you could have seen coming. This is exactly why I built Navexa. Not because spreadsheets don't work, they do. A lot of serious investors track everything manually. They build spreadsheets, they reconcile dividends, they adjust for currency, they keep detailed records. And if you do that well, you're already way ahead of most people. The problem is consistency. As portfolios get bigger, as years pass, as transactions stack up, manual tracking becomes fragile. One missed dividend, one forgotten fee, one currency movement you didn't notice. And suddenly, the numbers you're trusting start drifting away from reality. I wanted one place that showed me my real return, not just price movement. Not at tax time, not after the fact, but while I was making decisions. So I could allocate capital without lying to myself. So if you're happy estimating, then your broker app is fine. If you're happy maintaining spreadsheets and you trust them completely, that can work too. But if you want a system that tracks everything automatically and gives you numbers you can rely on, that's exactly what Navexa is built for. And you can try it for free for 14 days, links in the description. And if this changed how you think about investing, this is exactly the kind of stuff I cover here.